discover that the balance has been significantly depleted through layered deductions. Not because the customer borrowed money, not because the funds were invested into a loss-making instrument, but because over time, repeated maintenance charges, SMS alert fees, transaction-related deductions, digital banking charges, and other service layer costs gradually reduce the original deposit. And in some extreme cases, customers have even reported returning to inactive accounts that had fallen into negative balances despite no borrowing activity whatsoever. Now, importantly, this conversation is not about whether such charges are technically disclosed or legally permissible under banking regulations. In many cases, they are. But the deeper issue is whether ordinary people reasonably expect that money left untouched in a bank could steadily disappear primarily through system-generated deductions. And this is where the comparative international experience becomes important. Across many mature banking jurisdictions, particularly within parts of the United Kingdom and the broader European retail banking environments, ordinary current or savings accounts are generally not structured in ways where inactivity alone creates a realistic pathway toward progressive balance erosion of this nature. A customer may leave funds untouched for extended periods and still reasonably expect the principal balance to remain substantially intact, unless that account enters an agreed overdraft structure or optional paid services are activated or explicit penalty conditions are breached. In practical terms, the ordinary banking customer in many of these systems typically experience banking as a value preservation service first and a fee generating system second. And that distinction matters enormously because public confidence in banking is shaped not only by legal compliance but by whether customers genuinely feel that the system is fundamentally working to protect their money rather than gradually consume it through accumulated operational charges. And increasingly, many Nigerians no longer feel that assurance with the same level of confidence. This is not an argument against banking profitability, nor is it a rejection of regulated banking charges. Banks provide services, and services cost money. And sustainable financial institutions are essential for economic stability. That reality is understood. However, the deeper question is this: does the present fee architecture still align with the original public expectation of banking as a value preservation system? Because a system can be fully legal, fully compliant, and fully disclosed, and yet still produce outcomes that large numbers of customers experience as unfair. And once that perception becomes widespread, it evolves from a customer service issue into a public trust issue. From a broader policy perspective, several concerns increasingly emerge: cumulative microfee erosion, depletion of dormant accounts over time, weak customer understanding of long-term deduction impact, growing public perception of excessive value extraction through routine banking activity, and widening gaps between disclosure compliance and fairness of customer outcomes. At that point, the conversation moves beyond ordinary pricing policy. It becomes a question of financial system design and public trust sustainability. Now, it is on this basis that a protected basic banking framework should be seriously considered within Nigeria's financial system. Such a framework could include capped cumulative monthly charges for low balance accounts, simplified and easier to understand fee structures, stronger protections for dormant accounts, clearer opt-in structures for optional banking services, and special protections for students, pensioners, low-income earners, and basic savings account holders. There may also be merit in requiring simplified periodic cumulative charge summaries, which allows customers to clearly see the total impact of maintenance fees, SMS alerts, transfer charges, and other service deductions over quarterly or annual periods. Because while individual deductions may appear small in isolation, their cumulative impact and effect is often poorly understood by ordinary account holders. Long-term dormant retail accounts could also benefit from protective limits, preventing indefinite cumulative depletion through recurring maintenance deductions. Additionally, while it is true that certain services such as SMS alerts may already contain opt-out provisions within the Nigerian banking system, the practical process for exercising those options can sometimes become unnecessarily difficult, especially for customers residing outside of the country. In many cases, customers are still required to print out physical forms, complete manual documentation, and scan back paperwork, whilst navigating cumbersome submission processes simply to deactivate optional services. In an increasingly digital global banking environment, such processes may unintentionally discourage customer choice and weaken the practical accessibility of fee control mechanisms. Modern banking reform should therefore not focus only on disclosure, but also on simplicity, accessibility, and fairness of customer outcomes in practice. Because financial inclusion should not quietly evolve into financial exhaustion. No citizen should feel punished simply for keeping money in a bank. It must also be clearly acknowledged that Nigeria's banking sector remains one of the most advanced and innovative in Africa. The industry has expanded digital banking access, strengthened payment infrastructure, improved financial inclusion, and increased transaction efficiency, and also contributed significantly to economic modernization. Many institutions within the system operate with professionalism, discipline, and strong ethical standards. Now, this letter is therefore not an attack on the banking industry. It is a call for reflection. A reflection on whether system efficiency and customer experience are beginning to diverge in ways that may gradually weaken public trust over time. Banking systems are among the most important trust institutions in any society because they hold more than money. They hold confidence. And confidence rarely collapses suddenly. It erodes gradually through repetition, through experience, through accumulated frustration, through the quiet feeling that value is disappearing faster than it is being preserved. The responsibility, therefore, is not only operational efficiency, it is continuous alignment between efficiency, fairness, transparency, and public confidence. Because at the heart of banking lies a very simple promise that money entrusted to the system will remain meaningfully protected. And when citizens increasingly begin to doubt that promise, the system must respond. Now the letter has been delivered. The responsibility to reflect, reform where necessary, and preserve public trust now rests with the regulators, the policymakers, and the institutions that collectively shape Nigeria's financial system. This has been the mailman, signing off for the people. If you found this information worthy of your time, kindly click on the like button below and please turn on the bell notification, and do subscribe to this channel to help get the contents of these letters to the appropriate authorities and to support my channel. In the coming week, the mailman will be dispatching a follow-through letter and rendering its contents to an entirely different recipient. And I look forward to hearing from you in the comment section below to whom or where this next letter ought to be addressed. Stay blessed and thank you for your kind attention. Goodbye now.